Now, the minutes of the last Federal Reserve meeting at which the members voted to raise interest rates by a quarter point. Broadly speaking, there were three things that came out of the release. The consensus was that there was a concern that inflation is not going away and that more interest rate rises may be necessary. That is, of course, unless conditions change and economic data points to a very different sort of setup. That discussion came during the July meeting, at which it raised rates by a quarter point to between 5.25% and 5.5%. And that was, at the time, widely expected by traders to be the last in this current cycle of rate rises. But then came the release. Let's take a look at what happened in this. Most Fed members suggested that they foresaw further upside inflation risk that could merit further tightening. A couple voted not to raise rates in July. A number said balance sheet runoff need not end when rate cuts start to come through. These minutes noted that with rates at these elevated levels, members said the economy was expected to slow and that unemployment likely will rise from current levels. But staff economists retracted the earlier forecasts that troubles in the banking industry could lead to a mild recession this year. So what did it mean for what's been happening on the markets? Well, I want to take a look at what's gone on with the dollar basket, first of all. This is the trend that's been in place. Today we've got a red candle, but we've seen this prior the resistance at 103.20 pierced in the session earlier on this morning. And that gave us the highest print we've seen since the 12th of June 2023. And for that is significant. Yesterday we saw a candle close beyond the 200-day moving average, which itself is for some people a buy indicator on a trend. The trajectory of the MACD is up, meaning that people are looking for opportunities to get in on the trade, and the trade at the moment is long. So I think next stop-off point will be the highs that we saw on this market back in the 31st of May, when we're up at 104.26. Now, if you want a pair to trade this against, clearly it's going to be euro-dollar. And the euro, I think, is on the way down to 108.34, total retracement of this mark here. We've seen this line of prior support at 109.38 beaten in the last few days or so, and it would seem, technically at least, that the price target should be 108.34. Then comes below that, the 200-day moving average at 107.90 is another line to watch out for. And if you get a continuation of the drop for the euro, that is more interest in the dollar as the Fed remains relatively hawkish, then the next stop-off point is the 106.35, which were the lows we had back on the 31st of May.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.